Welcome back to the watch list. I'm Nicole Petalides. Rivian stock has been under some serious pressure today. The company announcing plans to offer a $1.5 billion convertible notes. David Trainer's with us, CEO of New Constructs. So when you see Rivian down 20% today, I mean, it's a huge move. And the company now, the offer of convertible notes, that's something here. I mean, the truth of the matter is Rivian could have some liquidity issues, and it's burning through, my understanding, $1 billion per quarter, according to at least one analyst I spoke to today. What do you think about what they're trying to do here?
And they're trying to stay alive. And we put them on the zombie stock list over a year ago, almost a year and a half ago, because they don't make money and they didn't have enough cash just to keep them around for more than a couple of years. So at some point in time, they're going to have to do this. And the stock's down because it's a terribly dilutive event for existing shareholders. Beyond that, though, the stock is still ridiculously overvalued, and it's a really struggling business. I mean, rarely do you see businesses that stay around for a long time that have negative 200% margins. I mean, it's a struggle. I'm not saying it's a bad vehicle. Look, I mean, it's probably a great deal. You're buying below cost, right? Just like the early Model S's, you got to buy those below cost. But yeah, we struggle to see how this stock is really going to be able to give investors much upside from here.
Yeah, I mean, when you see how they are burning through cash, as you noted, you had them on the zombie list from a long time ago, and that was something that you saw as a flag. I mean, when you looked at the cash burn rate and the cash on the balance sheet, is that something that you would use to determine what goes on the zombie list?
Yeah, absolutely. All the stocks on the zombie stock list have less than 2 years of cash runway. They're burning so much cash that their current cash holdings can sustain them for less than 2 years. Sometimes it's a lot less than that. And for most of those stocks, they've all seen really precipitous declines, and most of them have been forced to drastically cut costs or raise new capital. But it's obvious if you're doing the fundamentals, you're looking at the fundamentals. It's pretty obvious. If you want to believe the narratives, you can make a case that pigs will fly and Rivian will sell. I think the current stock price implies they're going to sell more trucks than Ford sold F-150s in 2022. That's what you got to do to justify around $19 a share. That's like 750,000 plus cars, more than 2% of the entire electric vehicle market. And again, more than the top selling truck in the world, Ford's F-150, more than what they sold.
Yeah. As I look at the big three, and obviously the strike continues, GM actually has less cash than Ford and Stellantis. That's one issue. Also, GM has secured $6 billion credit line just in case. There is some concern there about GM versus Ford and Stellantis. What do you think about that, Stellaris?
Yeah, Nicole, I mean, we're bullish on the legacy automakers. They're not burning through tons of cash. They've been more cash flow profitable than anything else. That's part of why they're having a strike, is that the workers have said, listen, you guys are making too much money. You need to share some of that with us. I think they'll figure that out. And I think that they will be major players eventually in the electric vehicle market. And we're going to continue to see what New Constructs has been saying for 5+ years, which is, as the electric vehicle market matures, you will see market share distribution similar to what you've seen in the legacy auto market. And the valuation of these EV startups are going to get crushed. And most of them, just like in the legacy auto market, most of the EV startups will go out of business. They won't survive. Most of the original car companies are no longer around today. And so the valuations in these EV companies are really risky. And we really definitely think investors should avoid those stocks and look for better values.
And I want to turn your attention to some of the other names that you've been watching. The first that you said was the Birkenstock IPO, which is coming here on the 11th of October here to the New York Stock Exchange. So a lot of people are excited because it's a brand they recognize and they think this is an exciting time to trade it. But in your opinion, you said investors should not expect really to make money on this, right? Why?
What do they say IPO stands for? It's probably overpriced. And that's certainly been the case in the last few major IPOs. I mean, we made the same call early on ARM, the same call early on CART. Again, both some businesses that have made money, Birkenstock has actually been profitable, but the valuation is sky high. It makes no sense that the stock should trade and have the future cash flow sort of required to justify the price. It's going to require significant international expansion where they have a real problem with intellectual property protection. People can get away with ripoffs around the world. So the ability to grow globally and sell the same number of shoes, comparable to some of the biggest brands out there, that's already priced in. And so we just think there's just not any upside here. IPOs are more about the private investors trying to make money. Sorry, Nicole, go ahead.
No, I'm sorry. Tell me about the names that are on the zombie list these days. Are there some that have just never gotten off in a long time? Just throw out some names so I could write them down so we can keep an eye on them as names under pressure.
Peloton, Sweet Green, AMC, GameStop. That'll give you a good sense of a bunch of them. They've all really been major underperformers. Beyond Meat is probably one of my favorites, just because it is such a competitively disadvantaged business. It begs the imagination that the business ever went public to begin with, and that it retains any value. But so it is with most of the zombie stocks, or all of them, right there. These are really competitively disadvantaged businesses that have been losing a ton of money. And as interest rates are higher and stay higher, Nicole, these companies are going to have a lot harder time raising that capital needed to fill the hole, burning in their cash flow. And that's a bad situation. I'm saying? It's going to be harder and harder to convince people, hey, we burned up through all that money. We can't pay back the last guy who loaned us money, so you should loan us money now. That's a tough sell.
Well, look, a lot of companies do that over and over again because they feel like they have value or something to offer. But the question is, buyer beware, because you're not exactly sure the value that's being presented. David Trainer, New Constructs, great to have you on the show. I liked the IPO. It's probably overpriced. I thought that was interesting. I hadn't heard that one maybe ever.
Thanks.
I don't know. I've been on Wall Street for 25 years. Somehow I just didn't hear that one. But it's something to think about.
You learn something new every day.
I say that all the time, David. That's why I love this job so much. David Trainer, New Constructs. Thank you.
Thanks, Nicole.